Welcome to Factful Finance, where we break down complex financial concepts and put you on the path to smart decisions. Today, we're tackling a question that many people find intimidating: understanding vehicle finance basics. Whether you're buying your first car or upgrading to a new one, vehicle financing can be confusing, but it doesn't have to be. Let's make this clear and simple so you can drive away feeling confident in your choices. Here's a surprising fact. The average car loan term in the US is now over 70 months. That's nearly 6 years. And with interest rates fluctuating, it's more important than ever to fully understand the ins and outs of vehicle financing before signing on the dotted line. Before we dive in, a quick note. This content is for educational purposes only. Please consult with a professional for personalized advice. Now let's get into it. First, let's cover what vehicle financing actually means. At its core, vehicle financing is the process of borrowing money to purchase a car, with the agreement to repay the loan over a set period of time, usually with interest. There are two main options when it comes to financing your vehicle: loans and leases. Car loans versus leases. When you take out a loan, you're borrowing money to buy the vehicle. You then make monthly payments to the lender, and once the loan is paid off, the car is yours. However, the size of your monthly payment is influenced by factors like the loan term, how long you have to repay, the interest rate, and the price of the car. The longer the term, the lower your monthly payments might be, but you could end up paying more in interest over time. In contrast, when you lease a car, you're essentially renting it for a fixed term, usually 2 to 3 years. Your monthly payments are often lower than with a loan, but at the end of the lease, you have no ownership of the vehicle. Leasing can be great if you like driving a new car every few years, but it's important to note that you'll also have mileage limits and potential fees for wear and tear. Interest rates and terms. One of the key factors in vehicle financing is the interest rate, which determines how much you'll pay in addition to the loan amount. A lower interest rate means you'll pay less in interest over the life of the loan. Your interest rate will depend on factors like your credit score and the loan term. Generally, the shorter the term, the lower the rate, if you can afford it. For example, let's say you're taking out a 60-month loan for a car priced at $30,000. If you have good credit, you might qualify for a 4% interest rate. Over 5 years, you'd pay around $3,500 in interest alone. But if you could afford to stretch it to 72 months, your monthly payments would be lower, but you might end up paying over $5,000 in interest. The key takeaway? Longer loans often cost more in interest. Down payments. A down payment is another essential factor when it comes to vehicle financing. The larger your down payment, the less you'll need to borrow, and the lower your monthly payments will be. Financial experts recommend putting down at least 20% of the vehicle's value. If you're purchasing a $30,000 car, a 20% down payment would be $6,000. This can help reduce the amount you pay in interest. Plus, it may give you some equity in the car right away. Loan terms. The length of the loan, or the loan term, is another crucial piece of the puzzle. Shorter loan terms, such as 36 or 48 months, generally come with lower interest rates, but your monthly payments will be higher. Longer terms, like 60 or 72 months, reduce the monthly payment, but often come with higher interest and total repayment amounts. For instance, if you take out a loan for $25,000 at 5% interest for 60 months, your monthly payment will be about $472. Stretch that to 72 months, and your payment drops to around $393, but you'll end up paying around $1,300 more in interest. The trick is to find a term that balances manageable payments with the lowest possible interest. Real-world application. Let's look at a practical example. Meet John, who just bought a new car for $30,000. John has a good credit score, and after researching loan options, he decides on a 60-month loan with an interest rate of 4%. His monthly payment is around $552, and he'll end up paying a total of $33,120 over the life of the loan. If John had opted for a 72-month loan, his payment would have dropped to $453, but he would have paid a total of $32,856, which is only slightly less, but the interest would have been higher. John's decision will depend on how much he can afford each month versus how much interest he's willing to pay in the long run. Tips for vehicle financing. 1. Know your credit score. Your credit score plays a huge role in determining your interest rate. The higher your score, the lower your rate will be. Check your score before applying for a loan. 2. Compare offers. Shop around and compare rates from banks, credit unions, and dealerships to find the best deal. 3. Avoid optional add-ons. Dealerships often offer extras like extended warranties or insurance, but these can add significant costs to your loan. 4. Consider the total cost. When financing a vehicle, always look at the total cost of the loan, not just the monthly payment. A lower payment might seem appealing, but if it means paying more in interest, it could cost you in the long run. 5. Make a larger down payment. The more you can put down up front, the less you'll need to borrow, and the less you'll pay in interest. Conclusion. Understanding vehicle financing basics is crucial for making informed decisions about your next car purchase. Whether you decide to take out a loan or lease, make sure you're clear on the interest rates, terms, and total costs involved. By carefully planning and comparing your options, you can secure a financing deal that works for your budget. What's the first step you'll take when financing your next vehicle? Let us know in the comments below. Thanks for watching Factful Finance. Be sure to like, subscribe, and hit the notification bell so you never miss an update. Drive smart, and see you in the next video.